Well, welcome everyone. My name is Jason Hamilton. I'm a wealth advisor and financial planning services manager up in Cincinnati. I want to welcome everyone today to today's Bright Ideas series. If you've been with us before, welcome back. If you're a first timer, which I'm going to suspect there's probably many of you that are a first timer to this call, especially with the acquisition that just took place, and you're probably coming to us maybe as a CB&T legacy client. We welcome you to the Stockyards family. Thanks for joining us. This is a series that we started putting on right when COVID really kind of popped its ugly head out a little over 2 years ago. And it was a way for us to keep clients, centers of influences, whomever it was, kind of updated on what was happening in the markets, what we were seeing. Sometimes it's an economic update. Sometimes it's a financial planning update. It just depends where we are kind of in the cycle. I try to do these quarterly. So I welcome you for coming on today. This will be recorded. So if you do drop off or have to get off early or know of someone that wanted to tune in but wasn't able, there'll be a link that probably comes out sometime next week when the recording's available, and we'll share that with everyone. Like I said, I'm in Cincinnati. This has been kind of perfect timing to have our guest today kind of speak about the markets. Here in Cincinnati, about the only thing worse than the Reds is the stock market. And I might actually have to say the stock market's doing a little bit better than the Reds. So, but nonetheless, we wanted to shed a little light on what's happening out there. A little housekeeping. If you came onto the call, please make sure you stay muted. If you're on via phone, we'll take questions at the end, and you can *6 to mute and unmute yourself. And if you're on a computer, you can use your computer icon for the mute and unmute to ask a question when we open up questions at the end. You can also feel free to use the chat icon that's on the bottom right of your menu to chat a question in, and we'll address those at the end also. With that said, today, thanks to the acquisition that took place, even though it happened, I guess it was announced almost a year ago, took quite some time for it to all come together and be finalized, but it finally did. And with that acquisition came a great bank, Commonwealth Bank and Trust, coming over to Stockyards Bank, and we've been pleased. Myself as a Stockyards employee working with our Commonwealth team, and especially our wealth management team. Merging almost $3 billion of assets into our existing client base has been, a little strenuous for those that are behind the scenes, and maybe even you as clients. And we thank you for your patience. But with it, it brought a great investment team that was led under Rob Hawkins and his team. Great expertise, great understanding of the stock market, the economy, and just all the fundamentals that go into it. So it's been a great pleasure working with that team. And that's who I want to introduce today is our guest speaker. So Rob Hawkins is going to be our Chief Investment Officer of Stockyards Bank. I know it sounds probably funny hearing it as Stockyards Bank. For those that have known him for the last many years. Formerly of Commonwealth Bank and Trust, where he spent a little over 10 years there. Lots of different backgrounds. Anything from building specialized portfolios, portfolio management, designing investment strategy, a lot of equity research in his background. As part of his past experience, I know he helped grow CB&T's assets over those 10 years from 800 million to upwards of a little over 3 billion in assets. So he's been a strategic partner along with the rest of his colleagues to do that. Part of his past experience goes beyond just CB&T, but he was with Stifel and Nicholas, which was formerly Legg Mason, Wood and Walker out of Baltimore. Spent a lot of time there on the equity research. And then prior to that, in Louisville, private equity and venture capital investments, where he's got a lot of experience there too. And I won't even go on with some of the other firms that he's participated with and helped them also grow. He's a graduate of Washington Lee University out of Lexington, cum laude, and then he's a Owens Graduate School of Business from Vanderbilt. So with that, I welcome Rob Hawkins to join us today. Rob, it's all yours. You may be muted.
Let me unmute it from there. Okay, looks like I'm in. Thank you. Appreciate it, Jason. I'll go through this and I'm going to share the slides that I have.
Okay.
Let's see if this works. Actually, let's try one more.
You're good.
I'm going to try to get a bigger screen for folks. It did not work. Okay, I guess we're going to have to go with that. Okay, so thanks again for joining us. I've got about 20 slides here to kind of explain what's going on right now in markets and as well as the economy. It's been, I guess it's been one of the worst starts for the Reds. It's also been probably one of the worst starts in 100 years for the market as well. Almost all asset classes have lost money this year. Bonds are in a bear market. This is the worst bond market we've seen since 1980. But I also remind everybody that the stock market is not the economy. Really what's happened here, most of these results have been what I'd like to kind of term as Fed-induced. So far, the Fed really hasn't taken much action, but it's become increasingly hawkish in its tone. And investor sentiment, repositioning for what may happen, has done a lot of this year's work for the Fed. And and you can see from the yield curve, having 10% rate up around 3%. A lot of what the Fed has talked about doing this year has already been priced in. We all know that the Fed would like to try to soft land the economy, and we all hope that it won't have to resort to extreme measures. But the market is already starting to lose patience with the Fed and patience with what may happen, and bringing us pretty close to a bear market as it stands right now. The other problems for markets have been the Ukraine crisis, the Russia-Ukraine invasion. Most of the geopolitical risk for this incident is pretty much already out of the market. If the market's down 17, 18%, maybe only 2% of it's Russia-Ukraine. However, it's taking out, one of the largest oil producers and one of the largest wheat and corn exporters in the world. And so it's exacerbating what the Fed's trying to accomplish here by increasing energy inflation and increasing food inflation with the crisis. So today, it looks like investors will become impatient and are making assumptions about what might happen with inflation and what the Fed may do. The market's down 13% at the end of April. It's down almost 18% year to date. A bear market would be down about 20%. From its high, we're down really from, year to date, we're only down about 18, but for the high was about 1% higher. So we're really down about 19 from high where you measure bear markets, and a bear market's down 20%. But if you want to put it in perspective, really what's happened here, this is mostly about cheap money, fiscal stimulus that flooded the economy during the pandemic that is now, being signaled that it's going to withdraw. And so the S&P 500 between the end of beginning of 2019 and the end of 2021, that 3-year period, the S&P 500 returned 100% with dividends. So basically doubled your money through that investment during that time frame. That's a very quick time for markets to double. That's about 3-4 times as fast as they usually double. And so right now we're reversing course a little bit on that. That extra money that put into the economy via fiscal stimulus boosted those returns. Now they're coming back, and really we've only given up about 13 or 14 months of return. If you go to the bond market during that same time period, bonds ended up for the last 2 years when the Fed took rates to zero, ended up generating an extra 10% above what they normally return. And so what have they lost to date? Roughly 10%. All the money that the Fed or all the money that went into bonds based on the Fed taking rates to zero, now that rates are back to where they were pre-pandemic, that extra 10% has now gone out. That's really all that's happened here. So if we kind of look at it right now, there are a lot of headwinds in the first half of the year that'll likely last a little more into the second half of the year. And some of these, though, have started going away. But there's also, some silver lining and a decent amount of tailwinds that remain for the rest of the year that should, again, make the economy stronger and kind of prove that that the stock market isn't necessarily the economy. From one standpoint on COVID lockdowns, this one appears to have gone away for most of the Western world, at least in terms of lockdowns. COVID hasn't gone away, and there are more variants coming. We're likely to get more surges. But how we deal with that has changed. Really, I think only China, Hong Kong, maybe some of the other Asian countries are only ones considering and dealing with this by a lockdown, to their detriment. I mean, they aren't going to be able to achieve herd immunity, and they aren't vaccinating their populations, and so they may not be participating in the recovery that the rest of the world does. But for the most part, COVID is over, and the lockdowns are over. The other one that's starting to wane again, the geopolitical risk that was priced in the market around February 23rd, 24th for those first few weeks, that has gone away as well. The only thing that's kind of the residual impact remains the impact on exports of oil and the supply of oil and the exports of wheat, corn, and a couple of other of food commodities, keeping kind of inflation higher. Supply chains also have signs, and it's a little tricky to read and a little hard to predict. And to date, no one's really forecasted this correctly. But by all accounts, the data shows that different parts of the supply chain and the logistic channels are easing up. Now, that might be a little bit of a head fake because there might be a lag to the impact of China and Shanghai locking down. But it appears that those parts of the market, those parts of logistics are adapting and finding other channels and ways to deal with the China bottleneck right now. Now, the Walmart and Target numbers that you saw yesterday, might be an impact of that, and we can kind of deal with that maybe in the question and answer session. But the real grand headwind for markets right now is inflation and what the Fed is going to do about it. And the problem for markets is the Fed has basically said all options are on the table, and markets can't really predict how high the Fed might take rates to handle it. What we do know, the market's really waiting for the Fed to go on autopilot. And autopilot is circumstances where the Fed says, hey, we're going to continue to hike rates, but only 0.25%, for the foreseeable future. When the Fed says that, that's when the markets can really recover. That's when businesses can kind of plan for what finance costs will be. That's when they can make investments and know kind of what their capital returns are, whether they're buying something that the financing costs won't exceed what they're paying for the company or what the returns of what they're buying might have to do. But until we get there, we're really on hold, and this is where the jitters are coming into the market. Now, the Fed has also told us one other thing, that they won't repeat the mistake of the 1970s. In the early 70s, inflation reached 13%. The Fed hiked rates, but they stopped too soon. They stopped ahead of the Ford-Carter election and really didn't raise rates again, and inflation reached 15% in 79. Paul Volcker was appointed the Fed chairman, and he came in and in a very apolitical fashion, hiked the Fed funds rate up to 20%. And at one point they reached 22%. But within 2 years, that 15% inflation was back down to 2 to 3%. And really what was needed to happen in probably 1973, and they ended up with a whole decade of high single-digit to low double-digit inflation. So the Fed says they're willing to do that, and that's what really has markets concerned. And they're really waiting to see, will inflation start dramatically falling off, which is what we hope, so that we can see the Fed start talking about not, the ability to go on autopilot. It's looking less likely, though, with last week's inflation read not coming in as low as everybody had hoped. So we're probably looking more at this middle case, that inflation declines gradually. We don't know, how gradual inflation can decline to make the Fed happy or to keep it from, doing a Volcker moment. We think it's at least till after the election. We had the head of J.P. Morgan's global fixed income in today. He thinks the Fed is going to try to avoid a Volcker moment for at least 2 years. But if the Fed were to do a Volcker moment, we're not talking about a 20% hike to Fed funds, which would put prime rate at something like 24%. We're looking, use the Taylor rule. John Taylor from Stanford, an economist there, kind of basically has a model that shows that you really need to hike Fed funds a little more than inflation to be able to bring it back down. And so we're talking about bringing Fed funds up to 6%. Now, that's probably would cause the yield curve to invert. That would probably throw us into recession within 12 months. That would also probably immediately start a bear market if we aren't already in one, if investors haven't already thrown us in one. But we don't think that's the base case. We really think it's more this gradual case. So in terms of tailwinds, we think the market could withstand the gradual case because there's a lot of positive tailwinds that are starting to show up, and it will continue to happen in the second half of the year. One of them is the job market. I know everybody's concerned about the job market. There's 10 million more openings than there are participants in the job market or unemployed, even if you add back some of the non-participation rate. But that'll start closing as these financial conditions are tightening. And already we're starting to see some of the things that might close this. For instance, low-wage workers are starting to run out of their savings. They got a lot of this helicopter stimulus money, during the pandemic. They're running out of that. That'll probably push them back into the job market. For the first time since the pandemic, we now have mothers returning to the market at a rate above where they were in pre-pandemic. In March, mothers working were above the level they were in March of 2019. So those are some positive things. That's showing, before we knew that having caregivers and child care available is one of the things that was keeping mothers out of the market, and that seems to be abating. So that's one pretty big positive for the market. The other one that everybody, I think, kind of forgets about, we still have $1.2 trillion in spending that has been passed. It looks like the rest of the infrastructure and fiscal stimulus spending, we said it wasn't needed last year. It doesn't look like it. It certainly hasn't been needed, and it's not likely to happen. But that $1.2 trillion will start trickling into the economy in a pretty big way for the next 3 years, but it comes in over 5 years. And for those of us in Kentucky, you're about to get an extra $5 billion in spending directed directly at the state of Kentucky to spend on infrastructure. Now, the best one probably for me is, we're a consumer economy. About 70% of GDP is made up of consumption. And the consumer is about as strong as I can remember the consumer. Right now, for the first time since 1990s, households have more cash than they do have debt. The data that came out from I think it's from Citigroup, or no, actually from maybe the JP Morgan data on consumer debt and so forth. Auto loans, the number of the level of non-performing loans is its best in history for auto loans, credit cards, and consumer loans, and for home loans. So the consumer's in really great shape. It's paid back debt. It has a lot of cash, and even more importantly, despite the spending, they're buying more than inflation. Inflation's been running 8%. They've been spending about 10% right now. Who knows how long that's sustainable, but it's showing that inflation is not curbing it. Even if you look at the Walmart and Target and the Home Depot sales, they had positive same-store sales growth over last year, and those were kind of record numbers even last year. So the consumer continues to spend. It's other parts of their cost structure that have become some of the problems. So where do we go from here from a valuation standpoint in the markets? Really, markets are about earnings. In the short run, it's about sentiment, and a lot of what we've been seeing in the sell-off is really sentiment-based. It's second-guessing. It's making the assumption that the Fed's either going to fail or inflation's going to get higher, and the Fed's not going to be able to control it or have to hike rates higher and put us into a recession. And therefore, we're going to go into a bear market. That's what participants, how they've been positioning and acting. I think it's too early to call for that, and I think if we get some decent inflation numbers, we have some continue to have dovish comments. Lately, they've been dovish. I know they were hawkish up to this point, but the Fed said it's standing pat on 50 basis point hikes. As long as we're getting that out of the next 2 months worth of Fed meetings and inflation readings, the market should, I would think, should stabilize back to about between 4,000 and 4,500 and get back to there. And that, if you take the median stock, is about 15 times earnings. And earnings, believe it or not, is 245. Just in the last week, this earnings number has risen to 251. The first quarter earnings were very strong. So either the companies are being fooled, and that's a little bit of what the scare around Target's and Walmart's earnings were. The company said they really didn't see or understand that inflation and the cost of shipping was going to be as high as it was, and they had to adjust their earnings. So in the first quarter, maybe not enough companies knew that, and earnings have to come down. But we're still growing GDP right now. This year, we're supposed to grow 3.7%, and we're supposed to grow 2.4%. That suggests really 10% earnings growth. And so what I say is you can slash earnings, but they probably really can't come back down to much below 230 for 2023. And where we are in the market right now, that's below where the average valuation for the market has been. So again, I think markets are ahead of themselves and pricing in a lot more worst case than they should be. So back to the silver linings, I think I've touched on a few of these, but again, the market's at full employment. The consumer's buying more than the inflation. They've got more savings than debt, and we've got this huge stimulus spending. Another thing that's kind of interesting for markets, it's a little tough to want to jump the gun, not knowing that the Fed has all options on the table and could hike rates higher, making your bonds lose more money. But right now, we got bond yields that you can lock in for customers that are with 4% coupons. We've even seen 4% coupons on very high quality muni bonds. So we're getting a chance to build bond portfolios with current coupon rates higher than we've seen in almost a decade. We're sitting down in the middle of June with the fixed income team trying to figure out, one, what to buy when we want to buy it, and maybe want to see another Fed meeting in late June and another inflation reading in mid-June before we do this, but we're poised to maybe jump in and start picking up some bonds for customers here and getting some nice yield into portfolios on high quality bonds. And that's not the only thing that we've been doing. We've been tilting into more, the stockyards, Commonwealth. We're both quality shops, quality growth shops. We like companies with clean balance sheets. This has not been this kind of market. A lot of the companies that were slow growers for the last decade have had to add a lot of debt to their balance sheet to keep their stocks up by buying back stock and paying higher dividends. Those dividend companies with higher yield that don't look so ugly, they've been doing really well in this downturn part of the market because people have been buying as bond proxies. We've tilted a little bit into value in that way, and we've picked up some other things that are kind of value oriented in areas like small cap. And so these rotations are helping us. We hope that we would see this year, right now, Europe and the international earnings are growing faster than U.S. large cap earnings. However, with the Russia-Ukraine crisis on the table, their economies look like they could be in peril. And so, as much as we'd like to over allocate to earnings growth like that, we've been having to kind of trim and rotate away from it. But portfolios are holding up really well, and particularly our bond portfolios. We were shorter duration, knowing that the Fed would eventually have to do something. And so while the bond market's down about 10%, a lot of our holdings, a lot of our bond portfolios are down less than half of that, or around about half that. So final comments is just to put things also again in perspective. What about bear markets? Again, given those silver linings, we think it would be a short-term bear market and a shallow one at that. But bear markets, even if it had to go longer, on average, bear markets last about 2 years before you get back to whole. And we, again, think it would probably be a lot less than that. We're already down almost 20%. Most bear markets, when you look at them on a monthly basis, they bottom around down 24%. So we're not far from the bottom. And so we're telling everybody, look, at this point, it's better to stand pat and not trying to time this. You're likely to do more damage exiting here and trying to get back in, because when they do turn around, usually that first year of the bond market or of the bear market, the markets recover more than 10%, sometimes 12 to 13% in that first year. And it happens in very short, quick bursts of time. And if you just happen to wait too long or miss that, you end up cutting your returns, by 25% to half over the next bull market cycle. The other thing is, too, we are global asset allocators, and there's a bull market somewhere. More often than not, when we go into a bear market, European and international markets remain in an uptrend. I would say EM markets have been kind of rolling into bear market territory in a lot of ways. If you look at the last 2 years, you could say growth stocks are in a bear market right now. Tech stocks are in a bear market. They're likely to come out of things faster and at a different time frame than the rest of the U.S. So being diversified, again, is the only free lunch, as they say in finance or economics. Some of these holdings may allow us to skip the bear market. So those are my comments. I went through that pretty quickly, but I wanted to kind of open the floor, since there is, quite a bit of volatility, to be able to answer questions for folks.
Yeah, so with that, Rob, thank you very much for the comments. For those of you that have a question, as I said, if you're on the phone line, *6 will unmute your phone, or you can chat a question into us. Anyone have a question? Rob, I'll ask you one, just because I don't know what everyone's investment level is on the call, but you referenced the vocal moment, I don't know, 3-4 times. Do you want to give specifics of exactly what that is so everyone understands that?
Yeah, so the Volcker moment is the scary. Yeah, it's kind of the scary part of what the Fed could do. So if you look here in 1980, 1981, these are quarterly numbers, but somewhere around the second quarter of 1980, inflation hit 15%. Volcker comes in and he hikes rates to 22%. Mortgages hit 17%. The yield curve tips, and it real quickly pushed us into a bear market, and we pushed us into a recession 11 months later, as you can kind of see on this one chart over here. And it pushed us into a bear market in 1980. And so the Volcker moment is when the Fed decides to just push rates up beyond the level, the rate is higher than the level of inflation, to break the back of inflation as fast as they can. And it took about a year and a half from that point. They had to leave rates up there for that time frame, but it came down. And if you look between the fourth quarter of 1980, where you're kind of still around 12, 13% inflation, by the second quarter of 83, inflation was back down to normal levels. So Volcker did this because he didn't want to repeat what happened here in the top box in 73, 74. They did a little bit, stopped, and inflation took off again. And he just didn't want to have a decade of rolling inflation, so he just really hammered rates higher. And and basically it stopped banks from lending. It stopped consumers from buying houses for about a year. And it cooled the economy off fast, and it cooled inflation off fast. Our Volcker moment wouldn't be 22%; it'd be more like 6%, kind of following kind of the economic math, the Taylor rule.
Okay, thanks. Anyone else? Anyone have a question out there? I did have some questions on whether we'd be providing the slide deck, and yes, when the video becomes available, the recording will be available early next week, and we'll figure out a way to send the video and this slide deck out to everyone also, so that you'll have it.
I haven't been able to, but may I ask a question?
Yes, you certainly can.
Okay, there's a headline in today's Washington Post that says the U.S. may be barreling toward recession in next year, more experts say. And I would like your comments on a recession and how we may be able to prepare for it or not.
Right. So the big question is, how what happens when you raise rates to this level? Will it, and we're at pretty much full employment, and we have a really strong consumer with a lot of savings. And so the question is, if we raise rates, and if you think about it, we've seen mortgage rates in 6-7% for if anybody's in their 50s, have seen it for most of their lives. It isn't necessarily the end of the world, but it kind of would cool temperaments. But the idea is, if we did that long enough, would it slow things down to where companies start laying off people? And the thought is, to get inflation back to 2%, we would have to go with unemployment from 3.6% to between 5 and 5.5%. And depending on if you use your forecasting doing that, and a recession is technically 2 quarters in a row of negative GDP. And so people think that, we might, and we're running about 2%, or have been for the decade, about 2% GDP. This year we expect to do 2 or 2.5%. But, could we take GDP growth down to, negative for a couple of quarters? And by the way, we had a negative first quarter because we were coming off such a strong fourth quarter. But can we do that for 2 quarters in a row? And chances are it'd be pretty shallow. But yeah, we may go into a recession on that. Most portfolios, I would think, are pretty well positioned, not knowing your situation, but I think we're looking at something that would probably be pretty shallow, and we're not not probably noticeable to most people. In my expectation, 5 to 5.5% unemployment is, closer. I would probably say we spend more years in the 4.5 to 5.5% employment range in the last 30 or 40 years than we have below 4%, which is, a lot of people think 4.5 to 4% is full employment. So to me, it might feel a little sluggish. It might feel like it did in 2013 or 2014, or it might feel like it did in 2003, 2004, 2005. And my guess is most people can't remember it feeling so bad then. But this isn't the kind of thing that is like the great financial crisis, when all these banks have problems that have to be bailed out, or anything like that. This is not kind of a systemic. This is more just the Fed inducing that recession and trying to slow things down so they can get inflation down. Does that help your understanding?
Yes. Yes, that was helpful. Thank you.
Any other questions out there? And I always leave it up to, we have an email address I'll give you if you're too shy to ask a question today. It's WMTquestions with an S at syb.com. You can always follow up with a question there, and we'll get back to you right away if you should have a question further on. But I'll ask one last time for any other questions. No? All right.
I have.
Go ahead.
You have time for one more brief one?
Sure.
I hate to politicize this. You've mentioned the Fed's contribution to bringing inflation under control. Is there any prediction or any accomplishments that the present administration can make outside of the Fed to try to improve the likelihood of controlling inflation?
It would be to stop spending money, or stop doing more stimulus. They're still talking about this 1.575 trillion Build Back Better plan, and it would pour more money into this. We've overstimulated is why we're here, and what has caused that inflation. It's the old classic, too many dollars chasing too few goods. And, the fact that we've got supply chain bottlenecks and a kind of a housing shortage kind of created by the last, financial crisis, is causing a lot of this inflation, and to put more money into the system, which is what you're going to hear on the campaign trail this fall for the midterms. You're going to hear the Republicans attacking him for it, saying that Biden and these guys caused it. But this is kind of we did what we had to do to pull us out of the pandemic. It's analogous to basically you walk into a house that the heat has been off and it's been closed down and below 32 degrees or freezing forever, below zero for a while, and you crank the thermostat up as hard as you can to kind of thaw it out as fast as you can. That's what we've done here, and it's overshot. Now we've got to try to cool it off. It's really that simple, and so we just have to stop throwing money at this. I think one big mistake that I can't believe the Biden administration is considering, or the Dems actually, I think the Congress is considering, are price controls on things that did not work under Nixon or Ford, and caused even greater inflation and caused even greater shortages when they try to do that on basic staples. So subsidies are being considered for gas and gasoline, and that might need to happen for low-income folks in Europe. Europe is looking at embargoing Russian oil, and if they do that, their gasoline prices might go through. That might be something that makes sense in certain ways. But I think they've got to stop doing a blanket stimulus and throwing more money into the economy as fast again, and I think that just puts us in a worse situation.
Can the Fed overcome inappropriate activity by the current administration, or in reality are they in reality sort of subject to whatever the administration does?
No, they can. They're independent. I think a lot of what I used to work with Jay Powell, the Fed chairman. Used to work for him. We worked on projects together. He used to be in office a couple of doors down from me. He is trying to maintain independence within the Fed, and the Fed. I would say that's one of the key tenets of what the Fed tries to do, and a lot of the fight over Lael Brainerd and all this stuff that happened behind the scenes, I think, was trying to keep it independent. And so the problem with that is that really probably will make the Fed have to go to one of these so-called Volcker moments in order to get inflation under control. If they start pouring more money into it, the Fed will have to counter that with much higher rates. That's the consequence of that, and the Fed will do it. He has said he will. He is a public servant of the old school fashion. He grew up in D.C. He walked away from a lot of partnership money. I can promise you he is doing this just because, he wants to be, kind of that, noble statesman. And he will keep the Fed independent to his ability. He will do what he can, but he won't hesitate to do what he thinks is right for the economy.
Is there any chance that Stockyards will let you do an interview on MSNBC?
I don't think they have a problem with me doing on MSNBC and CNBC. I don't think MSNBC would even would necessarily want me on. But no, I don't think we have a problem with that. The hard part with doing interviews is they tell you what they're going to ask you on the front end a lot of times, and then you go on and you prepare for that, and they ask you something completely different. And so you end up a little bit deer in the headlights sometimes. But I don't think we have a problem with that if somebody really wants us to.
Thanks for your help.
Happy to do it.
Two other questions for you, Rob, that came in. When you say you're rotating equities and bonds into more stable ones, are you doing that across individual accounts? You want to speak to how we're doing that?
Yeah, we're doing it across individual accounts, but we're also doing it within the models, within mutual funds. We're rotating to, we've been trimming some growth funds and buying some value mutual funds. We trim, if we had, a growth or a core mutual fund, a lot of our smaller asset classes like small cap and mid cap, we we get through mutual funds, we've swapped to a value small cap fund. One of the other things we're also doing for you on the bond, since this is a terrible bond market, what's kind of nice about bond funds is there's not a whole lot of difference. There's a little bit of outperformance between one investment grade bond fund and another one, but not a whole lot. But you can kind of see who the better ones are. But the second best one's really not that much difference in performance. So this year, if we've got 10% losses in a bond fund or 6% losses in a bond fund, we're taking that loss, recognizing that to reduce your taxes, your capital gains tax bill, and buying for at least a month, 31 days to prevent a wash sale. We're turning around and buying that number 2 bond fund and then swapping back into the other one and trying to create some tax savings. We're doing a lot of active things like that in this market. On the individual bonds, what we hope to be positioning for, and we're again kind of doing our homework now and sitting down and trying to figure out what our best ideas are in mid to early June. We're trying to figure out what's out there that we can buy now and maybe what we can sell that we own a lot of in portfolios. Can we swap a 2% bond that's maybe a little bit overvalued right now, a 2% coupon bond for a 4% one, and lock that in for 10 years? And that 2% one might be, coming to maturity in 2 years. We're looking at opportunities to do stuff like that to change around the portfolios and get us kind of earning and locking in at what we think. We think eventually bonds go back to 2 to 3%, where they historically have been. And so to lock in a 4% or a 4.5% or 3.75% coupon is a great thing to be able to do for our customers. So we're going to try to take advantage of it, but we run a little bit of the risk that the Fed could jerk rates real high on us, and we take some short-term losses in those. That's what we're debating. That's what we're trying to work on right now to make you guys more money.
Then last question, Rob. They want to know, what's your favorite book?
My favorite book. I guess you're looking at an investment book, possibly?
It's just a general question. So probably, right, investment related. What's your favorite book to read?
There are a lot of good ones. There's a real technical book I like a lot of the books by Michael Mauboussin, who was the strategist for us at Legg Mason for a while, but he's a Columbia business school professor, and he's back to doing that again. His books are really interesting. Kentuckians will like them because a lot of times he brings horse racing analogies into the books. I like a lot of older books. I mean, it's hard to kind of beat Benjamin Graham's value investing book that Buffett used. It's a little dated. I tell you, there's somebody one of my favorite ones I give to customers and buy them when they want to kind of learn how to do this is a book about how Warren Buffett invests. That was by Susie Buffett, his former daughter-in-law. He got divorced from one of his sons, and she and another one of Warren's early investors basically kind of wrote down the notes they would hear when Warren Buffett held dinners about the market, and she puts in a lot of great kind of explanations about how he thinks about stocks, and it's a lot of the way we invest. And I think that one, for anybody trying to invest in individual stocks, that's a fantastic book. And I think it's called Investing the Warren Buffett Way by Susie Buffett. There's even a workbook that goes with it that's kind of nice. A lot of these books, sometimes, about half the book's good, and that one's probably 2/3 of the book's good, and the other half gets redone. Last quarter gets done it. I also like an old school book. If you like histories, I like a lot of economic histories. There's a couple of great ones out. In fact, Greenspan and the Economist, the head of the Economist magazine, wrote a book on the history of the American economy. And I think anybody who's a history buff, anybody who kind of likes American history, anybody who kind of likes reading a little bit about it's more about history than the economics, but it's a really interesting story about how we got to where we are, how some of the things got changed in the government. And it basically kind of goes decade by decade from the 1700s. I think that's the history of capitalism or capital economics. I will try to get you, if anybody wants to email for those, I'll get a list of those and be able to share those.
Awesome. Now, Rob, really appreciate the time this afternoon. Everyone on the call, really appreciate you joining us. Thank you for being great, loyal customers. We do this periodically. I try to do something once a quarter. So be on the lookout. If you're new to Stockyards, be on the lookout for these invites that come through. I know a lot of times we as advisors try to send off some more personalized individual invites in the case this invite lands in your junk mailbox or whatever. So be on the lookout. They are kind of random, but we thought this would be a good one just given where we are with current economic situation, and we wanted to get Rob out there as our new Chief Investment Officer. So really appreciate that. Hope everyone enjoys the rest of their evening, the rest of their week, and we'll catch you all later. Thank you very much.
Thank you. Hope I get to meet with you soon.
Thanks, Rob.